Hello and welcome back to Make Finance Easy. Today's video is going to be how do you pick stocks and how analysts choose what to invest in. Everyone wants to know how do you actually pick good stocks and how do analysts figure out what's worth investing in and what's not. Today I'll break it down step by step in under 4 minutes. If you're new to investing, the truth is you probably shouldn't start by picking individual stocks. Most beginners do way better starting with index funds or ETFs like S&P 500 index fund, total stock market fund, or Nasdaq 100 ETF. Why, you ask? Because instead of betting on one company, you're owning hundreds of them at once. It lowers risk, grows steadily, and historically outperforms most stock pickers over the long run. For beginners, keep it simple. Invest consistently, don't try to time the market, but hold out for the long term. So, how do you pick individual stocks? Okay, let's say you do want to pick stocks. Here's what to look for: strong business. Ask what the company actually does. Do people need its products? Does it have a competitive advantage? And if so, what is it? Then you got to look at its financial strengths. Look at the revenue growth, profit margins, cash flow, and debt levels. Companies making money consistently are usually safer bets. Then we got to see its valuation. This means, is the stock cheap or expensive to buy? Analysts use things such as PE ratio, PS ratio, and comparing the price to revenue or earnings growth. And then we have to check its long-term trends. Is the company in a growing industry? Examples right now are AI, cloud software, renewable energy, and healthcare innovation. A great company in a dying industry is a problem. And then, finally, we have to look at management. Strong leadership matters. Bad CEOs can destroy a great business. The key idea is not to just buy the stock, but buy the business. So now, how do analysts know what to invest in? Here's the big question. First, they do deep research, a lot of fundamental analysis. Analysts read earning reports, company financial statements, press releases, industry reports, and competitor data. They study everything from revenue growth to what management said on conference calls. Then they look at their price targets. Analysts build models, usually in Excel, that estimate future profits. Then they decide what the stock should be worth. That's how they create price targets. Talking to the company. Many analysts meet with the company's executives, go to presentations, and ask questions most people never hear. And then they track big trends. They follow economic data such as interest rates, inflation, consumer spending, and global events. These can move entire markets. And then finally, they compare to competitors and do risk assessment. They check if a company is doing better or worse than others in the same industry they're in, and they rate stocks such as buy, hold, or sell based on both potential reward and risk. But here's the secret: analysts don't always get it right either. Markets are very unpredictable, even for professionals. So here's a simple way to think about it. For beginners, start with index funds. If you want to get more deeper into the process and do stock picking, choose strong businesses with solid finance and long-term potential. And analysts, if you want to become an analyst in the future, you got to do massive amount of research, data, modeling, but even they make mistakes. Investing isn't about being perfect, but it's about being consistent and thinking long term. So keep investing, and I'll see you guys next week for continuation of AP Macroeconomics.